Hi, this is Steve Hutchinson with Hutchinson Family Offices, and I've got a special video update I wanted to share with you. It's going to be on market corrections. I think this is going to be in about a two-part series, so we're going to take part number one. We're going to establish some definitions. We're going to talk about some issues that cause markets to correct, and we're going to identify some terms to help you better understand what happens when the end of a bull market occurs. First off, let's take a look at this bull market. Now, this bull market has been around since 2009. We're about 2,400 days long in the tooth with this particular market. Now, this came as a result of the 07-08 mortgage crisis, and as a result, the market pulled back dramatically. We saw a significant pullback in the financial markets. In fact, quite frankly, when you take a look at the subprime market, it was a 53% decline in the equity markets alone. Now, the question you have to ask yourself as an investor and when you're planning for your long-term financial future is, how am I positioned to take advantage, or how am I positioned to prepare myself against these particular market moves? Because they're going to come. These market moves are going to happen. And there's no financial advisor, there's no one that can predict which way these directions are going to come and where they're going to come from. It may come from overvaluations at some particular point, very similar to what we saw in the internet bubble. It may come from a geopolitical event, or it could come from Federal Reserve tightening interest rates, much in the same way that Paul Volcker did back in 1980 as he stamped out and wanted to stamp out inflation. So we've got to be careful when we're planning for your asset base, when we're talking about how to prepare for your financial future and whether or not you can sustain a 20% decline in asset values. Now, most folks, unfortunately, are not going to be able to withstand a 20% decline in asset values. So how do we prepare against that? Well, first thing we have to do is we have to understand what is the issue and what are the definitions of what we would expect. Well, the first thing, there's basically four basic definitions in the financial markets. The first one is risk. All investments involve risk. There's different types of risk. There's systemic risk, there's inflation risk, there's tax risk. But the risk that most people are identified with is loss of capital. Second, there's volatility. This is the day-to-day movements, week-to-week movements, month-to-month movements in the financial markets, up and down. What a correction is. What is actually a correction in the market? And then what is the end of a bull market cycle? Let's go through these one at a time. Risk is very, very straightforward. Risk is the potential to lose your capital. If you're invested in the financial markets, whether it be the bond market, the stock market, any kind of financial market, you're not in control of that particular risk. The only thing that you can do is diversify against it, and that would mean by stepping outside of the financial markets, looking at alternative investments. Volatility. Volatility is a way of life in the financial markets. Volatility creates opportunities for investors. It creates opportunities for buyers. Risk and volatility sometimes are shared in the same words. They're not the same. Risk is loss of principal. Volatility is the movements of the financial markets up and down. Let's take a look at what a correction is. A correction normally occurs in any market cycle, although we haven't had very many of them in this particular bull market cycle. But a correction is normally a 10% decline in the value of the asset. So the stock market will pull back 10%, maybe from its current levels down to approximately 1850 in the S&P 500, something of that nature. That's not unusual. 10% pullback does not necessarily mean the end of a bull market. What is the end of a bull market? The end of a bull market is a 20% across the board decline in equity assets. Now, that would be devastating for a lot of individuals, particularly those that are in retirement, close to retirement, or well, if you will, position themselves for retirement. This is going to be a big issue, and these end of bull market corrections will come. We can't stop them. And what will trigger something like this? Well, it could be the Federal Reserve increasing interest rates very quickly. maybe to stem off inflation. It could be geopolitical risks, which seem to be on everybody's mind these days. Geopolitical risks, maybe problems in Europe, other parts of the world, or even domestic issues could set off the end of a bull market. So one of the things to think about is can I withstand as an investor, can I withstand as a retiree a 20% decline in my asset base? And how do I prevent that from occurring? Well, you really can't stop it from occurring. But what you can do is you can possibly look at the alternative investment scenarios of investing in investments that aren't generally recognized to be affected by declines in bull markets. For instance, how much of my portfolio is allocated to real estate? How much of it is allocated to commodities? How much of my portfolio is allocated to private equity? Now, we're not recommending that you start shifting your investment strategy to create these alternative investments because they're not appropriate for everyone. So the bottom line is so what we want to do is point out that diversification into different types of asset classes can limit the effects of a end of bull market cycle. Let's take a look at a few bull market cycles and what happened. If we go back to the Great Depression, which is the end of bull market of all bull markets, there was a loss in the financial markets of 86%. It took 22 years for the financial markets to regain the original value. If we take a look at the oil crisis, when we saw oil prices go from $1.50 a barrel all the way up to 7 or 8 or 9. I mean, it was a tremendous shock, financial shock to the world, Arab oil embargo. That was a 46% loss in the financial markets, and it took 6 years to recover. If we go back to the internet bubble, that was a 44% decline in the market with a 5-year recovery time. And if we look at the most recent end of bull market, which would have been the subprime crisis, that was a loss of 53%, and it took 4 years for the financial markets to recover. Now, there's no pattern to this. So what you have to do is sit down with your advisor, sit down with your team, and determine, am I on the right track, and am I taking more risk in my portfolio than I'm comfortable with? And what would be a strategy for me to reduce that risk? Now, remember, with a reduction of risk, potentially becomes a reduction of potential returns. So if you're dependent upon the financial markets to create exceptional returns so you can have a comfortable retirement, diversifying that risk isn't necessarily going to replace the asset loss or the asset growth. You could diversify into other companies. I asked our senior portfolio manager, Todd Walker, to prepare a couple reports for me and kind of talk about a few companies that we have in our portfolios that we believe have long-term value and are fairly valued. For instance, we're very comfortable with companies like Microsoft, Amazon, Walmart, things of that nature, and that we consider these core holdings. Now, none of these companies, particularly let's take a look at Microsoft. Microsoft has got a forward PE of about 18, which is just about what the S&P 500 is. Is it overvalued? We don't believe it is. We believe there's a little bit more potential in Microsoft, although that's something you would have to determine with your financial advisor to see if that's appropriate. We take a look at Amazon. Amazon, on the other hand, has a target price of about $1,395 a share as posted by Morningstar. Is that a good company to own? That's something you need to consider. But these are financial assets, and financial assets are at the risk of what the financial markets will do. So it's very important when we talk about the financial markets and when we talk about what level of risk you're willing to take, which we're talking about is how much capital are you willing to lose in the market. Most people are going to say, I don't want to lose anything. So the alternative is to create a household endowment model that utilizes alternative investments and puts you in a better position. Now, overall, what do we believe at this particular point? We continue to believe we're going to see more volatility, particularly as we move into the election cycle. We got about 2 weeks from the taping of this video. The financial markets are going to continue to be more volatile. We believe that over the long term, below average returns will prevail in the equity markets. By that, I mean 6 to 8% would be a really great rate of return. It's going to be difficult. We do see some additional risks in mutual funds, and these are some things that do concern us about what we see in mutual funds right now. The SEC has come out with some additional regulations. It's going to require mutual funds to have a sufficient amount of liquidity for 3 days should there be a market pullback, or if you will, a panic by investors. These are going to have a dramatic effect on the markets. So it's good to sit down with your financial advisor and go through each one of these particular steps and make sure that you're assessing what level of risk you're taking, how much volatility are you willing to absorb, and what is your financial goals and what an end to a bull market cycle will do. That'll do it for this video. If you have any questions or concerns, please give us a call. We'll be more than happy to share with you our insights and what might work in your particular situation. Thank you.